All right, good morning. I'm Mike Fouché from Grown In. Thank you very much for joining us for our last panel, but we'll have workshops in the afternoon. Our panel, Borrowing Using Cannabis Company Real Estate Leasebacks. And before we get started, I want to thank our lead sponsors, accounting firm MGO. MGO provides industry-leading experience to help operators, regulators, and institutional investors navigate the complexities of the cannabis and hemp industries. Law firm Locke Lord. Locke Lord's Cannabis Group consists of skilled lawyers from a cross-disciplinary team that works on capital raising, licensing, compliance, and more. And Illinois Equity Staffing, cannabis and hemp industry training, payroll, recruiting, and human resources administration for companies that value diversity, equity, and inclusion. And we're very privileged today to have three really terrific panelists. I promised them all that I would say they are awesome. So I'm sure their resumes will prove that out. Trip Murray, Chief Financial Officer of Revolution Global, a multi-state operator based in Chicago. Trip has 17 years of investment banking experience, culminating in over 30 closed transactions. Anthony Coniglio, CEO of New Lake Capital Partners. Anthony co-founded New Lake in 2019 and served as its CEO until a merger with Green Acreage in March 2021. Prior to co-founding New Lake, Mr. Coniglio, Anthony, we're not going to be that formal here.
Thank you.
With the Chief Executive Officer of Primary Capital Mortgage, a residential mortgage company. And Richard Acosta, CEO of Inception REIT, or Real Estate Investment Trust, for those of us in the know, which focuses on originating, acquiring, financing, and managing a diversified portfolio of commercial real estate loans and net leased properties in the regulated cannabis industry. Gentlemen, thank you all very much for joining us today. I'm really excited to have your pooled knowledge and wisdom for us to tap into today. First, I want to get into what exactly is a real estate leaseback and how it works. I'm fortunate enough that I went to business school, so somebody taught me what that is, but it's not exactly clear to everyone. What is a real estate leaseback and what are the mechanics for somebody that is interested in obtaining a real estate leaseback? Can we start with you, Richard? Can you give us just an overview of that?
Sure. Well, it's quite simple. I should probably break it down into its two components, right? Component number one is sale of an asset that's on an operator's balance sheet. So step number one, the asset is sold to somebody like Anthony. That's step number one. It's full transfer ownership. Cash moves from our pocket over to the operator's pocket. That capital can be used for corporate use, expansion. Step number two in sort of the process is execution, and this happens simultaneously. Execution, long-term lease, right? And under the lease, the operator is allowed to use assets. So from an operator's perspective, there is no change in the day-to-day, right? You retain full control of the asset going forward. Generally, our leases are 10 years plus for retail assets, 15 to 20 years for industrial type assets, which include primarily cultivation type of operation. So that's a very high level description as to the two steps involved in a sale lease section and the rationale for it.
And Mike, if I could just add, not so much on mechanics, but people may not be aware that sale leaseback transactions are not specific to the cannabis industry. In fact, if you were to look at Starbucks or Walgreens or FedEx or Home Depot, any sort of retail-oriented platform, or even say a Prologis that does logistics, industrial logistics properties, this type of transaction is very, what I would say, regular way for companies that have large real estate footprints. So this is not a label for, oh, I have to do a sell leaseback. In fact, it's a way to get a hard asset such as real estate financed by a group of investors that want to own hard assets such as real estate, not a group of investors, if you think about it, that really have invested in a cannabis company. Do they really want their capital tied up in real estate? or do they want that capital going to grow revenue and grow EBITDA?
And Trip, I want to ask you a question, but before I do that, I want to point out to everyone, if you look on this side of your screen, there should be a little arrow that you can push so that you can get chat. My partner, Eric Davis, is running a chat in there. Talk to each other, but also post questions that you want to ask of the panelists. I would really love to hear what you want to know so that we can talk about it. Trip, once somebody does a leaseback, what does that look like from the perspective of the company that did the, what do we call it? The company that did the leaseback versus the company that lended to you? Is it the lender and the owner? Tell me that.
Yeah. So, I mean, I think, let me take one step back, Mike, just for a second for people to understand, I think, sort of the evolution of the capital markets from an operator's perspective, and how, both Richard and Anthony's groups have helped to facilitate the continued expansion in the cannabis space. So, in the 2012 to 2014 timeframe, when Colorado was moving from medical to adult use, you couldn't get real estate financing. It was high net worth individuals that were putting in equity capital. If you had some non-traditional financing loans, you were looking at 20, 22% coupons with warrants. And then sort of in the 2016 to 2017 timeframe, there started a specialized REIT. And as Anthony was talking about, REITs have been around for 50, 60 years. It's a tax structure to deploy capital into specific industries. And when the cannabis REITs showed up, it allowed operators such as ourselves to deleverage our balance sheet with hard fixed assets instead of raising capital on an equity basis. So they became non-dilutive financing sources for us. But, to answer the question now, as Richard said, it's a two-step process. I would personally own, Revolution would own its assets. At the point in time in which we did a transaction with them, there'd be one step that we sell the asset, and then they become the landlord and in essence lease it back to us. Hence the concept of the sale leaseback. And we've just become a tenant within a building of a structure of cultivation or retail that we had already developed, paid the capital for, but then found an alternative financing source through the cannabis REITs.
Okay, I'm going to ask a really basic question. Richard, how does an operator who sells the asset to a REIT or some other organization, how do they guarantee that they're going to continue to have access to this property, develop the property, those sort of things once the leaseback is conducted?
It's under agreement, right? It's just leasing any other piece of real estate in a non-sale leaseback transaction. What we do primarily is do triple leases, and what that really means is we're side for our investors, effectively a bond. Right? This is meant, if you will, sort of an asset management approach. Right. So, and we obviously are underwriting really for you on operators' ability to execute, on its ability to continue maintaining the property, obviously. Our investment, right? And we're long-term holders, we're really looking to asset value and leaning on operators pretty heavily to maintain the property, and it's responsibility on net leases. So it's really, the answer to your question really is it's protection afforded, and it's a right afforded under the lease itself.
And typically, how long is this lease agreement? Anthony, can you talk about that?
Yeah, so the lease agreements are typically 15 to 20 years for most industrial properties. Sometimes it's a little inside 15 years for retail properties, but there are also typically add-on periods. So renewal options at the end of the lease term could be 2 additional 5-year terms at the end of the lease term. And from our perspective, we don't like having disruption in terms of changing out tenants. So for the operators that want to be in a property for a prolonged period of time, that's perfect for us. We want them to continue to utilize the property and pay rent, quite frankly. So it's in our interest for the operators to stay in that property as well.
So how does a cannabis company have to be legally structured for a real estate leaseback to work? Is there some particular concern about an arm's length relationship or these sort of things with the lender or even internally for the company? Richard, can you talk about that?
Yeah, there's no sort of bright line test. Every situation is different. Some companies are C Corp, some are LLC. I think from an asset specific perspective, requiring it from a single member LLC, let's say, sometimes that's an easier transaction as acquiring a C Corp with a bunch of commingled assets. But generally it's a tax and legal exercise. I've never come across a situation where on this deal, I can't acquire this asset. On a deal that I want, right? You can generally figure these things out. Anthony, you might have a different perspective or experience.
Yeah, I would add to that, Richard. Thank you. I would add to that we typically have guarantors. At least in our case, we always have a guarantor because as cannabis companies have structured themselves from a legal perspective to deal with 280E and other structural issues, we often find that the actual tenant isn't always the organization that has the full financial substance of the company that we're interfacing with. So we'll typically have a guarantee up to that ultimate parent company. But I agree with Richard. There's really no magic to it. It would be stretching the imagination to think about an organization that was structured in a manner that didn't allow us to execute on this transaction.
So this is different than a mortgage because you're no longer the actual owner of the property. You're leasing the property. And that also changes some of the requirements for how you structure your company. For instance, I've heard that banks are squeamish about doing mortgages with cannabis companies that directly own their property because of the cannabis legality rules and banking. So that's not a concern for you guys, Richard and Anthony?
I'll jump in here. It's actually the opportunity for us, right? The absence of traditional financing for real estate has created the vacuum of capital that we're sitting here and filling. Now, we are seeing some local banks getting into the business of providing capital for real estate. But what I would say is that the existing REITs today that Tripp was talking about, right? These have been around for decades. Those REITs are competing with the large money center banks today. And the reason is these properties, as many of your listeners and as many of the participants here know, are highly specialized properties. On the cultivation side, they have investments for power, HVAC, security, water that are over and above what an alternative use is. And so Richard and myself and others like us spend an exorbitant amount of time really understanding the needs of Tripp and his business to be able to get comfortable to provide capital over and above what most other traditional real estate providers would provide should they ultimately decide to come in. But I'll just go back, Mike, and say that is the opportunity because of the difference between federal and state law. Most of the national banks won't participate in this sector, and most of the national existing real estate REITs won't participate in this sector.
So Tripp, as somebody who's trying to find what do we call these? Purchaser, a partner, a REIT to work with, how do you sift through these different companies in order to make a decision about who is the right kind of place to work with?
Well, I think a lot of it depends. It's on the state in which you're operating and the capital requirements for the operator. I mean, let's put into perspective the type of capital that an operator on a 75,000 square foot facility would look for, right? You're talking close to $30 to $35 million. So you need to be able to partner with a financing source that has the wherewithal with that capital. Now, if you're talking in some place like, let's say Florida, for instance, Florida is a unique market. It's a fully vertically integrated market. And one of the things that a lot of the REIT providers look for is a form of collateral, which is a pledge of a license. So when you're looking at a cultivation, if you're a cultivator in Illinois, like we are, we have a cultivation license. We do a sale leaseback transaction. We're able to pledge that as part of the collateral package. Because as Anthony was discussing, you know, the regular way use of a 75,000 square foot box in the middle of Illinois is not going to be $35 million. It's a special use facility. So the lender wants to make sure that they have a collateral package that if there is something that happens with that operator, another operator can step into that facility and continue on with that asset so that their fund continues to receive rent or lease payments.
Okay. But how do you, as an operator, figure out who it is that you want to
So
do business
first
with?
is the capital constraints, right? Do they have enough capital for us? And then two, we put together a detailed data room. We put together all of our licenses, construction plans, growth plans, financial projections, and we entertain offers from multiple different capital partners, just like you would do in any type of traditional type of financing. We would have to try to play Richard versus Anthony and push them down on lease rates or management fees, or maybe they club together one day and they all come in at the same time. But it's a common step of financing. But we've all been in the industry together. There's only a handful of seasoned large REIT providers. We know them. The REIT providers know most of the privately held multi-state operators like Revolution. So we're in constant communication, especially when another state opens up. And if we win a license, all of a sudden, Richard and Anthony will give a call. Hey, what are we financing in that state? Can we participate with you?
Yeah, I would just add, Mike, if I can, I think for the operators that are in the audience, this is a critical point that Tripp is making around knowing who the counterparty is, because I'm sure we could probably talk for an hour or two just on the number of stories in the industry over the last 2.5 years that I've been involved in it, where groups have signed up transactions such as these sale leasebacks only to not close on them. Many people enter into the business out of traditional real estate thinking, this is just another real estate deal. I will pull together lending from the bank friends that I have. I will go to the typical sources. But time and again, it's proven out that getting financing for this sector is so much more difficult than any other sector right now. And so they will sign up an LOI. They'll say they'll close in 60 days. Many times, I know for us, and I'm guessing Richard would say the same, many times we'll actually see a financing package for a deal that we lost to somebody because they just don't show up. They just don't have the money is really what it comes down to. And then they don't close. And so many people, both public and private companies, private and public companies, have been burned waiting for somebody to show up at the closing table. So understanding that your counterparty has not only the capital to be able to close today, but also if you have expansion plans, many of the deals that we look at, particularly on the cultivation side, are building out a portion of the available capacity at that location, and they will require additional financing or tenant improvement dollars to build out the next third, and then ultimately the completion of the building. So understanding that you've got a partner that can continue to fund your need over the next 2, 3, 4 years is an important element of that decision-making process.
Mike, that's such an important point. Raised it, Anthony. The execution point is huge. We've been in the space 3 years, and you're right, Anthony, that packages, deals that I passed on, and sometimes, there's us that have this expertise and sort of the know-how, financing for the same asset, multiple parties, right? Capital constraint is, and it's capital is just one part of it, as you just heard Tripp and Anthony. It really is the know-how, expertise. I had, in the last months, way REIT do exactly what Anthony just described, right? Try to bid on a deal only to come to realize, hey, this learning curve is very steep. This is a highly nuanced exercise, right? So only through kind of repetitions over the last, I think, Anthony, you've been in the space almost as long as I have. You kind of up the curve, and you really kind of hit a rinse and repeat type of model and mode. So for your audience, it's critical know who your counterparty is. Make sure that not only do they transit space, not only do they have really capital on balance sheet, but really they're folks that you to live with and work with for the next 10, 15 years.
So I have a couple questions from Corey Waltz, one of the attendees here today, and I want to start with this one. As a landlord, I've seen some sales leasebacks where rent rate decreases as term progresses along a more traditional 1% to 2% growth. I understand as the market matures, margins will decrease. Is this more or less your experience? Anthony?
No, I'll jump in. All of our contracts have annual escalators. That's very regular way inside and outside of cannabis. So no, that's not our experience at all. You typically have escalators that are either a set percent or are based off of inflation.
Richard?
I would really, that would be the exception to the rule, any built-in decrease.
And Tripp?
I agree. That's sort of how the sale leasebacks have been structured. I heard people talking about sort of potential resets of release rates. Federal legalization occurs, but that's only been conversations. That's the concept of what happens to the cannabis world when federal legalization occurs is a dream that everybody talks about, but we have no basis to be able to dream in that. So, but it's a standard escalator. And to your audience question, yes, there does become decreased margins in non-limited licensed states, which is another key, I think, point of importance for both Anthony and Richard and for ourselves at Revolution. Where the operator decides to participate is important. Limited license states usually keep higher prices and higher margins longer than full open, open states. That's where we participate. That's how we're able to handle sale leasebacks. Because we participate in that type of market.
Tripp, you brought up a great point, which is federal legalization. At our first panel this morning, 3 investors all agreed at least 5 years, maybe 10, before we see any kind of federal legalization, maybe some sort of banking act, but certainly federal legalization overall is going to be a while. I have another question from our audience here, Dave Gambasini. Maybe I'm pronouncing this incorrectly. Sorry, Dave. Do these REITs consider outdoor cultivation facilities, or are they only interested in indoor controlled facilities? Anthony?
Primarily, our locations are indoor grow facilities. Depending on the climate, we may consider. We have yet to do any sort of full outdoor grow facilities. I think for us at NewLake, we like focusing on facilities that can have an alternative use. And at least if you have an industrial building that maybe 15 years from now won't be used for cannabis, at least there'll be another use for that. And so if you were to look at actual farmland in outdoor grow, what is the repurpose of that? So we would really be looking at the alternative use and making the assessment.
What about greenhouses?
So there are some greenhouses. Some of the greenhouses are fairly high tech indoor grow facilities, and so it really depends.
It's not an indoor grow, but it's a greenhouse,
right? And it really depends. Some people have fixed roof greenhouses with the retractable curtains, really more for light deprivation. Some people have hoop houses, which are less valuable. It really comes down to the transaction. It comes down to what is the cost, where is it, what is the alternative use. If the greenhouse is located in an area where there are other greenhouses where we could easily redeploy that asset to a different industry, we're going to have a lot easier time getting across the finish line in the transaction versus a greenhouse where there isn't a similar type property for miles and miles and miles and miles.
Richard?
And it also really depends on the operator as well, right? Because remember, we have a guarantee from the parent company. And so if we have to if we're looking at a greenhouse, we might look for a higher quality guarantor to compensate us for the increased risk if we were to have to take that property back and relet it.
Okay. Richard, similar experience?
Yeah, I'd agree with I think all of those points. I think for us, we maybe have a bit of a different perspective, and it's something we should have touched on earlier. Our history and on the West Coast, we really economics. We view, we at some interstate commerce, and so that view really leads us to kind of prioritize building houses, right? In both locations, right? It's sort of, as Anthony said, you don't want a greenhouse in the middle of nowhere to tell that repurposability and the repositioning story. So for us, we're outdoor grows. Never say never, but the economics have to line up, and there has to be sort of a long-term narrative around an asset. Makes sense. So our now on the non-industrial side really is for fully enclosed greenhouses. We're talking, indoor facilities that are been right. You're benefiting from a lot of efficiency. At the end of the day, we're sustainable as well. We think long term kind of where the world is going, right? The push is everyone goes towards sustainability, and you really assuming a tremendous amount of power, right? The power density fully indoor it's comparable to data centers, and they're similar uses. For us, we're gravitating to greenhouses. We love the sustainability, and of course, it's because it's earlier fixed income investing. I guarantee you looking for those long-term cash flows. So you have to obviously line up with your or credit analysis.
Okay, another interesting question from an audience member, John Paul, who asks, cannabis facilities are expensive to build and may be overbuilt for alternate uses in the local area. Does that limit the leased value and require an operator or a landlord to put more equity in? Anyone want to jump in on that one?
Why don't I start, and then maybe it'd be great, Trip, because I know that you've looked at whether it be debt or sale leaseback. I don't want to sound like I'm benefiting our sale leaseback model, but really this is where we provide value. We understand the properties. We understand that sometimes we're investing in properties at 2, 3, 4, 5 times the alternative use value. And we get very comfortable with that because we look at the state, we look at the cannabis ecosystem, we look at the tenant, we look at the guarantor, and we could ultimately get comfortable from that. If you were to go to a traditional bank, where we have seen banks playing, a traditional bank will give you a 60 to 70% advance rate against the alternative use value. So if you're 4 times the alternative use value and you're only getting 70% of 1/4, you're just not getting a lot of proceeds. But Trip, you might want to add.
And I think it's sort of 2 different financing structures. The loan to value financing structure is really from I'd put that more on the commercial construction loan. So if you're talking to somebody who's willing to help you finance from the ground up, right? Revolution doesn't have an asset on their balance sheet yet, and we have a license and we want to build it, then that's where you can find some form of alternative financing for construction financing, where then we would have, somewhere between 15 to 30% equity into that construction. It's a 5-year term, and we have, prepayment penalties for the first 24 to 36 months as we're building it out. But then once that construction financing is finished, that's when then Revolution or a cannabis operator would physically own that asset, which then is where we turn to our partners from the sale leaseback and flip that asset to them, putting more cash back on our balance sheet. So the question is a great question, but it's putting together 2 different forms of financing: the traditional mortgage construction financing versus the sale leaseback.
And that's a really interesting proposition that you had here. So when you're building facilities, you're getting a construction loan, and then pretty much as soon as you've completed the facility, Trip, you're moving to a leaseback?
At times you can. I mean, again, the scale, sometimes I think the scale is lost on what 75,000 square feet for cultivation is like. You depending upon where you are, that's a 12 to 16 month construction build with all of the electricity, the lights, the security, the technology that goes into the buildings to ensure that there's no infestation. So we're financing the construction build of it, and then again, they would probably have 3 years left on it that we would still pay amortization of principal and interest. But once we physically own the asset after that period, that's where we can then turn it over to Richard and Anthony, or we can turn it over a little bit easier, get the construction loan guys, pay it off. They're happy. They got their money back, and then we've entered into the partnership with the REITs.
Yeah, and there's 2 points I would make here, Mike, if I may jump in, is one, we do also do what are called build to suits. So in that situation, instead of somebody going the construction loan route, we could actually enter into the contract, acquire the property on behalf of the future tenant, and provide the tenant that provide them the funds to actually get construction going. So many of the projects we're doing today and looking at today to fund are these build to suits. And then the second thought is when you think about LTV, we're just talking construction costs. And part of building these facilities is benches, racks, equipment. You typically don't have us providing financing for that because as REITs, we have to invest in real estate assets. We're not equipment finance companies. And so what you'll see is some people will look at the cost of getting a facility up and running, and they'll forget that you can't get the racks and the benches necessarily from your real estate partner.
So I'm curious, there's a lot of these smaller companies that are out there that have these very expensive facilities. When I say smaller, they're indoor grows of 5,000 square feet of canopy, under 10,000 square feet of canopy. Trip Revolution is a fairly large company as cannabis goes. How do you think one of these smaller companies, Trip, should be approaching considering a leaseback?
Well, it's a standard one. I mean, I don't think that there's necessarily a formula depending upon the size of the facility. I'm sure that Richard and Anthony, look at anything from 10 million up to $50 million. And that 10 million, can be used for that operator because most likely they have put, as Anthony was talking about, they have a build to suit. That's sort of a new way that the REITs are participating with the operators, because historically the operator had to raise, most likely at that, in the earlier stages, equity capital to put into the building to then be able to perform the sale leaseback. So if you have a smaller operator who has 10,000 square feet of canopy, you're talking 25 to 35,000 square foot building. If it's located in the right place, depending upon what the cash flows are pulling out, Richard and Anthony, I'm quite sure would be very happy to look at that financing of, $10, $12 million that goes back into the operator's pocket.
Yeah, I mean, we actually had an example of that without naming names. We had a company back in 2019 where they had a smaller facility. They had plans to expand on that facility. So we did a sale leaseback on the building, helped them use some of those proceeds to start the build out of call it the phase one. We provided additional TI to complete phase one. And then we purchased the parcel adjacent to them. And we're doing a build to suit that's just about complete for another 100,000 square feet. And so they were a smaller company. We provided them the capital to be able to expand, which then provided them the ability to scale up their operations significantly. And they ended up getting bought out by a large public company. And so when you think about these smaller companies, the difficulty for them is they get to this scale, but then it takes a lot of money to really go and accelerate the growth and go from a smaller single state operator to a more meaningful player in their state ecosystem.
Anthony, are you doing these sort of build to build-to-suit deals with organizations that are building out their first facility, or is this really for expansion?
Yeah, it's a good question. When it comes to building out, what we've yet to do is do a transaction with a startup. What we like to see is a track record of a company that's proven that they can cultivate. Cultivating is very difficult, as I'm sure many of the listeners are nodding their heads. We've seen many people open up a facility thinking they'll be able to cultivate and sell whatever their projections are for the first year, only to come in at 25% of the projections because they didn't quite anticipate the difficulties in adjusting the environmentals, or the difficulties in going to market, or some of the price pressures because there was additional product coming to the market at the same time. What we like to see is to make sure that some of these newer companies have the ability to actually get off the ground and drive cash flow, and if they're not profitable, at least have that line of sight to profitability. So
how much time under their belt do you generally look for one of these companies before you consider a build-to-suit or a leaseback at all?
Yeah, for us, it's a sliding scale, depending somewhat on the guarantee. If you have a very highly capitalized company, tangible capital, a lot of companies focus on their capital number, but they've done M&A, so there's a lot of intangibles. But if they have a significant amount of intangible capital, we'll go shorter in time, right? Because that's the guarantee. This is a credit play, as Richard talked about earlier, where we need to make sure we get paid our rent in order to deliver for our investors. And so if we're at a point where we have somebody that doesn't have a great deal of history in cannabis, we could look at their history at maybe operating businesses in other highly regulated industries, and then look at their significant capital position and try to get comfortable that way.
When you say intangible capital, you mean equity investors that have more resources available to them?
No, I was just talking about goodwill, to be more specific about it, right? Some people have built their company through M&A, and you look at the balance sheet and they say, oh, I have $200 million of equity. Yes, but you have $190 million of goodwill on the balance sheet. So really the tangible equity in the company, which when you think from a liquidation perspective, what's the tangible equity of the company to be able to meet its obligations?
Is that a real thing? Do people actually do that? $190 million of goodwill?
I was making up numbers, but if you go back through this industry,
not too far off.
Yeah,
not too far off from the 2017, 2018 gobble of MSOs that hit the Canadian markets. There was a lot of paper that was being traded that created a lot of goodwill and tangible value for them. And they wrote it down.
Well, of course they did.
In the 2019, 2020 time.
And what are they carrying this goodwill on? It's not like they're Coca-Cola or something like that. They don't have a brand like that. I mean,
well, some of it. Go ahead,
yeah, just a standard accounting. Your purchase price over your book value is, for simplicity's sake, goes into your intangible goodwill. Now, you used to write that down over the course of time, 15 years ago for any CPAs that are on the call. But now you have to do an impairment test. So operators every 12 months have to do an impairment test relative to the acquisitions that they've made. If the acquisition continues to succeed as anticipated, you have no change in your goodwill. But if the acquisition has decreased in value, you'll see companies with an impairment charge for those.
Okay, so that is very interesting. So, Richard, are you still there? Do we still have you?
I am here. I'm here laughing. Okay. Your audience, Google Canadian cannabis impairment. See the long laundry list challenges that we've had assessing credit for sure. But yeah, it's about, I'll just make one point. There's no magic with respect to experience, let's say, but it is a balance, right? You are looking for someone that you can really underwrite an operator, and also somebody that you feel adequately capitalized to run a business plan. So I don't want to rule out these small operators. We try to go into analysis with an open, but those are really balancing phase of the company.
So I've heard,
Mike, I would just say, here's yet another example. It's the value of these properties is an example where the specialized knowledge is from people that traffic in the industry and wanting to have a counterparty that understands the nuances. It's these balance sheet understandings that are important to make a credit decision, because people ultimately ask the question. So you address it in the diligence up front. There's also another example is 280E, really understanding what is a company's tax liability when it comes to 280E, because people can show a certain amount of cash flow. And if you don't close the loop on really understanding how 280E gets paid, when it gets paid, and how it has to get paid, and how that ties into the cash flow of a company, that's another area. So, all of these are elements of underwriting that I think if you want to make sure your transaction closes, you should make sure that the folks that you're talking with understand all of these nuances.
So that brings me to a question. I've heard of cannabis startups beginning with, there is the company that is the actual cannabis startup that has the license, and then there's some sort of a semi-arm's length relationship with an organization that owns the properties. And is that something that is integrated directly with it? How do you think about those things? Anthony,
Sure.
Can you answer that?
Yeah, sure. It's not unusual. We see structures like that all the time. I think many companies utilize structures like that for two reasons. One is for 280E purposes, to try to minimize the tax liability. And in some cases, and in many cases, it's because some of the initial equity owners look at the real estate and say, I'll fund the real estate. That's a hard asset that I could own. And the way that I can contribute capital to this entity is by actually owning its real estate and leasing it back to the company.
So that's
but I think for 280E purposes, you have to be very careful of related entities. So if all of the people who are on your cap table own the license, also own the real estate.
Yeah.
Not being an IRS expert, but they're going to sort of say, hey, guess what? That company actually owns that. So that 280E trying to get around isn't going to be available. So, when you talk about structuring cannabis, for anybody who's starting, I highly recommend, from 7 years of experience, get yourself an accountant that understands cannabis and tax structures, and get yourself a law firm that helps to document it correctly. Because going back in time is challenging. So start off, if you're going to be a long-term participant in this, spend the money to get the right accounting, tax, and legal advice as you enter into this market. Because now there are seasoned individuals who have been doing this for 5-6 years from the accounting perspective that have been through audits. So having those people on your side as you navigate the tricky waters of cannabis will be invaluable going forward.
That's great advice, and we're getting close to wrapping up here, and so I want to go through and ask the three of you, from your different perspectives, Anthony, what is the one set of things that you really wish that people had when they approach you to come talk about a leaseback for their company?
I'd say preparation in one word, but to be more specific, I suggest that people run their business as if they're going to sell it. Whether you are or you aren't, run your business as if you're going to sell it. So keep books and records in an organized manner. Make realistic projections that someone's going to hold you to. And we often see people that submit projections. There's one very quick story. Someone submitted projections and they were a startup. And we looked at their numbers and we looked at the amount of sales in the state that they were starting in. And we said, so you think in year one, you will have a 20% market share in your first year of operations in this very well-developed state? And the response was kind of stunned. They ultimately said yes. My point was, you immediately lost credibility because there's no way a startup will take 50% market share in any of these states. And I think they just put numbers down without really thinking through it. And then the other thing is audit. We like to know that the numbers we're looking at have been reviewed and ideally audited by an accounting firm. And we've had situations where people send us spreadsheets for their financials. And while I think they're probably good, trustworthy people, from our perspective and for our investors, we can't just trust that a spreadsheet is accurate.
Richard?
I would agree with all that.
What do you want people to bring?
Yeah, I would agree with all that. Sure. I think where people really trip up with really business, we'll start to obviously are kind of looking at looking at really the real set of circumstances and trying to underwrite kind of the today, right? If your business kind of stayed steady state, what really do they look like? So, it's creating a plan and having it, regularly updated, accessible. All right, that's aside from records, that's generally folks sort of fall apart sometimes, right? Not being able to substantiate kind of the next 12, 18, 24 months. It's just being prepared. And ideally, our situation is somebody that has a data site that's effectively maintained kind of on a regular basis, right? It helps us get through credit underwriting, business underwriting in a much more efficient manner, as opposed to kind of sending one-off emails and us trying to piece this together on our own. So organization, and I think earlier, starting out very early with tax and guidance and advisors is huge. It may feel expensive, but that really save you time, and it'll make your real estate or otherwise much more efficient. And I think sponsors here are among the most well versed when it comes to cannabis tax and accounting issues. So plenty of resources out there to put the right advisory.
Thank you for that plug, and anyone can just go to this corner and click on one of our sponsors. Trip, any last thoughts as somebody looks at considering a leaseback, you as somebody who's gone through this process from the operator side?
Yeah, I mean, I would talk to as many of the financial partners as possible. Get to know them, get to understand what's in the term sheets. Make sure that you understand how it plays out for the long run. And make sure you push back on Anthony and Richard to get their rates lower. That's what I really need at the end of the day.
Bad advice.
Okay. Well, so push hard, guys. Thank you all very much for participating in this. I want to thank everyone who has been through our panels this morning. And I want to remind you that we have some incredible workshops where there's small groups where you'll have an opportunity to be able to talk with the people that are running the workshops. Our first ones at 1:00 are the regulatory side of transferring a cannabis license. Then 280E, Beyond the Basics, and recent updates from both attorney and a CPA. And then at 2:00, Reducing Turnover, Strategic Employee Training with VP of an MSO with a tremendous amount of experience with this. And then also at 2:00, Marketing Your Cannabis Opportunity with two really experienced marketing professionals, cannabis marketing professionals. Thank you again, everyone. Thank you to our sponsors, accounting firm MGO, law firm Locke Lord, Illinois Equity Staffing, and our speakers, Trip Murray, Anthony Coniglio, Richard Acosta. Thank you so much for your time today. This was really fun, and I learned something.
Thank you.
Thanks, Mike. Have a good one.
You too.
Bye-bye.
Take care.
Bye.